The Interim Budget Financial Year 25 prioritized fiscal consolidation over welfare schemes, and continued to focus on better spending quality by propelling capital expenditure. This indicates that the Government of India is walking the talk on its commitment to long-term macroeconomic stability, even if it comes at the expense of growth in the short term. Inclusion in Global Bond Index, path to fiscal consolidation, and estimated lower gross borrowing in financial year 2025 provide tailwinds to softening of 10-year G-Sec yield going forward. We reiterate our view to increase duration in the fixed income portfolio, to capitalize on the softening of yields, in the next 1 to 3 years. 65% to 70% of the portfolio should be invested in a combination of high-quality roll-down strategies, like G-Sec or AAA, equivalent through a combination of 10 to 14 years maturity bonds, or funds. Multi-asset allocation funds, which aim to generate efficient risk-adjusted returns, through a combination of debt instruments, and arbitrage. Equity savings funds, aim to generate higher returns than traditional fixed income, and moderate volatility through equities, arbitrage and fixed income instruments. To improve the overall portfolio yield, 30% to 35% of the overall fixed income portfolio can be allocated to select high-yield NCDs, private credit strategies and REITs or InvITs. For liquidity management or temporary parking, investments can be allocated to strategies like arbitrage, and ultra-short-term for a minimum 6 months, or in liquid for 1 to 3 months, or overnight for less than 1 month. In financial year 2024, realty, PSU banks, energy, auto, infra have outperformed IT, FMCG, and private banks. Most of the sectors are trading at a premium relative to their historical valuations. Hence, investment decisions need to be more bottom-up going forward within sectors. Ongoing phase look similar to financial year 3 to 7, due to healthy earnings growth. Large cap valuations are more attractive relative to mid and small caps. The temperature gauge index is in the fair value zone. The equity market outlook remains positive, based on the deleveraging of corporate balance sheets, an uptick in the CAPEX cycle, and an expected steady trend in profit growth over the next few years. For existing investors, as per their risk profile, investors, with the appropriate level of equity allocation, should continue to remain invested. If equity allocation is lower than the desired levels, we recommend increasing allocation by investing 100% lump sum in large cap and multi-cap strategies. For select mid and small cap strategies, we suggest a staggered investment approach over 6 to 12 months. For new investors, 100% lump sum in large cap and multi-cap strategies. For select mid and small cap strategies, we suggest a staggered investment approach over 6 to 12 months.